Welcome back to CFA program, exam preparation. This is study session 5, reading number 15. Today's topic is multinational operations. Let's get started. Introduction. 2 types of F.C. activities. 1. Transactions denominated in FC. 2. Invest in foreign subsidiaries. What is foreign currency? Companies decide currency in international trade. FC transactions are denominated in currency other than company's functional currency. Different types of currencies. 1. Presentation currency, in which financial amounts are presented. Mostly, located country's currency. 2. Functional currency. Currency of primary environment entity generates and expends cash. 3. Local currency, where the company operates. 2.1 Foreign currency transaction exposure to foreign exchange risk. Company may expose to exchange rate on transaction exposure. Delta in value of FC assets or liabilities from FC transaction G/L and IS, both IFRS and U.S.GAAP. Transaction exposure. Import purchase. FC may appreciate at payment date. More functional currency to buy FC. FC may depreciate at payment date. Less functional currency units after conversion. 2.1.1 Accounting for foreign currency transactions with settlement before balance sheet date. Basic principle: all transactions at spot rate on transaction date. FC risk when transaction and payment date differ. 2.1.2 Accounting for foreign currency transactions with intervening balance sheet dates. BS date fall between transaction date and settlement date. FC transaction unrealized G/L and IS at BS dates. BS date to transaction date G/L are recognized. G/L of both periods must equal to total actual G/L. Delta exchange rate causes FC transaction G/L is 2.2 Analytical issues. Neither standard indicate where in IS, FC transaction G/L should be placed. 2 Most common treatments. Other operating I/E. Non-operating I/E, part of net financing cost, some cases. Operating profit margin affected by the placement, no guidance from standards. Comparison may distort B/W companies. Analyst also concern about unrealized F.C transaction G/L and IS. 2.3 Disclosure related to foreign currency transaction gains and losses. It is useful for companies to disclose amount of FC transaction G/L, both standards require. Presentation alternatives, no specific requirement. Contractual arrangement between 2 or more ventures. Companies often neglect to disclose location or amount of G/L, if immaterial. Several reasons for immaterial G/L, e.g. limited transaction, G/L offsetting, hedging activities. Delta in F.V of undesignated hedges and other income, amounts not disclosed. 3. Translation of foreign currency financial statements. Companies have operations in foreign countries. Consolidated financial statements under both standards require currency translation. Both IASB and FASB have very similar rules for translation. 3.1 Translation conceptual issues. While translating, 2 questions must be addressed. Appropriate exchange rate for translation. How is BS brought back into balance? 2 Approaches for translation. ANL. All ANL at current exchange rate. Monetary ANL at CR. Non-monetary ANL at HR. 3.1.1 All assets and liabilities are translated at the current exchange rate. FC balance sheet accounts are revalued in term of functional currency at current exchange rate. Negative translation adjustment not results in cash outflow. Issue whether unrealized translation G/L in IS or equity. 3.1.2 Only monetary assets and monetary liabilities are translated at the current exchange rate. Only monetary assets and liabilities are at current rate. Same issue as in 3.1.1, translation adjustment is unrealized, whether G/L to IS or equity. 3.1.3 Balance sheet exposure. ANL translated at current rate exposed to translation adjustment. Net asset BS exposure A is greater than L, translated at current rate. Net liabilities BS exposure less greater than A, translated at current rate. Effects of currency fluctuations on BS exposure are same as in 2.1.2. After initial period CTA is required to keep BS balance. 3.2 Translation methods. 2 approaches. 1 Current rate method. All A and L at current rate. 2 Monetary/non-monetary method. Variation. Temporal method. Measurement basis preserved. ANL at FCBS at CR translated at CR, ANL at FCBS at HR translated at HR. Appropriate method depends on funct. Currency. Certain indicators to determine funct. Currency, similar under both standards. If indicators are mixed, then management judgment. 3-step translation approach, both standards. Identify funct. Currency translate FC. Balances to functional currency. Use current rate to translate into parent's presentation currency. 3.2.1 Foreign currency is the functional currency. Function currency different from parent presentation currency. C.R method. All ANL at CR, equity at HR, RNE at average rate. CTA keep BS balance under CR method. Entire investment exposed to translation G/L. CR method results in net assets exposure, except negative equity case. When FC in value positive, CTA and vice versa. 3.2.2 Parent's presentation currency is the functional currency. Temporal method. Term remeasurement under U.S.GAAP, local currency to functional currency. Temporal method procedure. Balance sheet. Monetary ANL. Current rate. Non-monetary ANL. Measured at H.C translated at HR, measured at current value, C.V determination date rate. Income statement. RNE related to non-monetary assets. Rate used for assets. RNE not related to non-monetary asset. Average rate. Remeasurement G/L in IS, assume the G/L will be realized in near future. Monetary liabilities often exceed monetary assets, so net liability exposure. HR differs with cost flow assumption as 3.2.3 Translation of retained earnings. Equity translated at H.R under both methods, create somewhat problem in translating retained earnings, different rates. R/E equals accumulated previous year's income, dividends. 3.2.4 Highly inflationary economies. Cumulative 3-year inflation rate 100%, U.S.GAAP, similar guidance IFRS. Cease to be highly inflationary, then the functional currency must be identified to determine the suitable method for translating the entity's F.S. Approaches for translation. U.S.GAAP. Temporal method. Avoid disappearing plant problem. IFRS. Inflation, restated financial statements, then current rate method. Foreign currency strengthens. Current rate method. Income, revenue, ANL, total equity and vice versa. Temporal method. Revenue, ANL, and vice versa. Net income, equity. 3.5 Translation when a foreign subsidiary operates in a hyperinflationary economy. Temporal method, U.S.GAAP. First restatement of financial statement, then CR method, IFRS. 3.5 Translation when a foreign subsidiary operates in a hyperinflationary economy. Temporal method, U.S.GAAP. First restatement of financial statement, then CR method, IFRS. Restatement procedure. Balance sheet. Monetary ANL. No restatement. Non-monetary ANL. HC adjusted for delta and price index if items are at HC. Restated from date of revaluation if carried at revalued amount. Equity. Restated by applying delta and price level from BEG. Of period or contribution date F later. Income statement. Restated from item recording date to BS date. Net purchasing power G/L in IS. Holding monetary assets during high inflation PPL, monetary liability PPG. Results can be very similar under two different methods. Similar exposure. Same result if % delta in exchange rate equals delta in general price index in high inflation. 3.6 Companies use both translation methods at the same time. A parent company uses temporal and C.R methods at same time, under both standards. Firms under same industry can use different translation methods, judgment in funct currency. CTA to net income for comparability. 3.7 Disclosures related to translation methods. Both standards require two types of disclosures. Amount of exchange difference in net income. Amount of CTA along with reconciliation. Dirty surplus accounting income items as part of equity rather G/L and I.S, e.g. CTA adjustment. Disclosures provide detail to move from dirty surplus to clean surplus. 4. Multinational operations and a company's effective tax rate. Multinational companies incur income tax in the country of profit origin. Transfer prices price change on intercompany transactions. Companies set transfer prices such that a higher portion of profit is allocated to lower tax rate regime. Analyst can obtain information about the effect of multinational operations from companies' disclosure on effective tax rate. Delta in effective tax rate could be caused by delta in applicable tax rate and/or delta in profit mix. 5. Additional disclosures on the effects of foreign currency. 5.1 Disclosures related to sales growth. Companies make disclosures about foreign currency effect on sales growth in MD&A section. Growth in sales from volume and price is more sustainable than sales growth that comes from delta in exchange rate for a multinational company. 5.2 Disclosures related to major sources of foreign exchange risk. Sensitivity analysis is often used in disclosures about the effects of currency fluctuations. Analyst can use sensitivity analysis disclosure with own forecast of exchange rate when developing forecast of profit and CFS. Thank you everyone. That is all for today. We hope this information is useful to you. If you are willing to continue with these lessons, subscribe to the channel. To find more videos, quickly like and share the videos. You can also ask the question in comments, we will happy to answer. Here is some glossary of words to understand and learn. Let us meet in new topic.